Good morning, guys. It is Sterling here. Well, still morning on the East Coast. 11:55 in the morning, 11:55 a.m. New York time, Eastern time, and we are looking at a chart of the pound here. Basically, we had a setup, a stop run of a level. This is a predetermined level. It's the level I chose in the review, so I chose it. It's about noon right now. The reviews generally post around 2 a.m. Eastern before the start of the European session. I like to get it out usually around 1 a.m. actually, just before the start of the European session, so our members can watch that review, get the levels that I choose an hour before the European session. Or if they trade New York, obviously you don't have to watch it at that time. You just watch it before New York starts or before you start trading. And again, this is one of the predetermined levels that we had chosen. Basically, it was the highs of yesterday's active session. So when I'm looking at a level, what I'm looking at is I'm saying, okay, where are the orders at? Where's the liquidity at? Remember, banks function simply based off liquidity. What they're looking at is where can I buy? Where can I sell? It's not as simple as the decision that you and I make, which is where do I want to sell? Where do I want to buy from? That's a question, and the only question that we ask. We don't ever ask the question of where can I buy? Where can I sell? Because we can buy or sell from any location on the chart because most of the time the retail traders' orders don't go to market. Even if they do, we would never eat up all the liquidity at that specific point in the market at that time, unless you're trading a massive size, and again, you are going to market, which is maybe 0.0001 of the retail trading market. Very small section that could actually eat up any liquidity at a level. So if you look at it from the perspective of the banks, which remember that's exactly what we do at Day Trading Forex Live, that's all we do, that's all we care about. And if you're asking yourself, where's the liquidity? Where are the orders sitting? Well, when you're going above a previous day's active session, what I'm looking at is where has the market been responding in the past? If you take 1,000 traders and you put them in a room, I can guarantee you some of them will understand indicators, some of them will understand EAs, some of them will understand this, that, and the other thing, 100 different options. But one thing I can guarantee you is that every single one of them, or I'll say 95% of them, will all understand previous turning points in the market, basic support and resistance. That idea will affect the vast majority of their trading. They may use an EA, but they probably use previous support and resistance for possible stop location or take profits, or if they take entries based off of a candle pattern, they're probably using previous turning points in the market for profit targets or stop locations. And the same is true when you look at any type of strategy. Previous turning points in the market is almost always a reason to consolidate orders. It often consolidates orders, and that's why the market makes these type of response around previous turning points. So it's about selecting the levels that are likely to be manipulation points and then seeing the manipulation at that level. So in this case, we had a very high response point. It was the high of yesterday's active trading session. And so when the market breaks above that point, anybody that was short through, from the start of the European session yesterday on would now officially be underwater if that high starts to break. Therefore, it becomes a very likely stop loss location. It also becomes a likely location for anybody that is looking to buy on a breakout of that level. So the first thing that I look for is a 3-pip break of that point. Okay, so that's where we had this candle right here. We get our 3-pip break. Now what I'm waiting for is what we term as our confirmation candle. Now the confirmation candle is two very simple criteria, and I'll link to a video below this that breaks down the confirmation entry. But basically, the confirmation candle in the case of a short has to do two things. It has to close below the body of the previous candle, and it has to close in the lower 1/3 of that candle, lower 1/3 of that specific candle. So we just got our confirmation, and the entry needs to pull back to, this is the minimum entry here. So the reason this is a minimum entry is it needs to pull back to within 15 pips of the high. That'll allow me to use a 20-pip stop. So what I need to see is I need to see this market pull back to 48.55. If I pull back to 48.55, that's where I'll be taking the entry. And so as soon as we pull back to 48.55, which is right here, basically, the high of these candle bodies, if we touch that point, that's where I'll be taking the entry. The beauty of these entries is, again, I choose these levels hours in advance. I choose them, and if you're trading the New York session, I choose them at least 7 hours in advance, and you can do the same thing. Where the liquidity is sitting is something that we can choose long in advance because that does not change in a short period of time. Therefore, it gives us the ability to trade from a wider perspective. We don't have to be sitting there staring at the screen. I know if we're not near a pre-selected level, I have no reason to look at the market. And then in combination with that, the entry is at least a 30-minute entry. So if we're not near a level, I don't need to look back at the charts for another 30 minutes. That is huge when it comes to a limited time to trade. That's why a lot of our traders are able to trade from a phone. They're able to trade from, from work where they're only having to glance at the chart every 30 minutes because they glance at the chart. Are we near a level? Nope. Okay, well, I don't have to look back for another 30 minutes. So, anyways, I'll be taking the entry here at 55 with a 20 pip stop. See if it gives me another 3 pips on the pullback, and I will come back for the conclusion of this video. Alright guys, it is Sterling here, and I am back with the conclusion of this trade. I came back the following day. I didn't get a chance to finish up the video last night, but obviously we can see the result of it. Going into the trade, as I mentioned last night, what I wanted for an entry point was 55. So here was the setup. Here was the predetermined level, and remember, all these levels that I had on the chart at that time were selected during about this time right here, which is around midnight Eastern. So it's selected hours in advance, in this case about 10 hours in advance. The market comes into this level. It gave us our confirmation. This was on the chart as we were sitting there, and all we were waiting for was a pullback. We got the pullback. It pulled back to the entry point. Entry point again was 55. That allowed for a 20 pip stop. And this trade came down, and just prior to the 5 o'clock cutoff, because I close all my trades at 5 o'clock, it hit the 40 pip take profit. So it took 40 pips off that. That was going to be the conclusion of this video, but we had a really nice setup on the pound that I want to cover the very next day. And so again, let's go through the pound. When I do the review, my daily market review, I was doing the review right around this time here. And this level, the 48.61, was broken prior to the start of the session, so we threw that point out. As we came into our lower level, just to give you a walkthrough of what a review would be like, we came into the lower level. We had 48.12 set up as a manipulation point. Notice how the market blows through that level. This is a massive part of the entry criteria and all the filters. So many times people focus on, how do I get into a trade? How do I get into this type of move? How do I get into that type of move? And they fail to focus on what I believe is the most important, and that is, how does this strategy keep me out of trades that I shouldn't be in? Not to mention, this was a news-based move, so I would not have been in that move regardless of whether it's set up or not. But the point here is that if we don't have a valid confirmation entry off a level, that's how we invalidate a level. And then when the market opens and closes beyond it with 2 consecutive candles, that officially takes that point out. That's what happened here. That level gets taken out. The next point to the downside that we had as a potential manipulation point was 47.55. This level was again selected when the market was all the way up here during Asia. This is in last night's review. All of it is done 10 hours in advance. There's no backtracking on it to change it. It's in video format every single day in the room. I'm choosing these points every day. And comes into the next point, 47.55. What do we have here? Well, we have an absolutely classic news-based stop run. After the news, the market is the low liquidity market that often follows news is used to drive the price into a manipulation point. Beyond the previous day's high, or the previous day's low in this case, where my cursor is, you're going to start to have a mass of orders below that point. That is a very high liquidity point, or a high point of interest where the liquidity may be sitting, and then we wait for the next confirmation, which is a valid confirmation setup during tradable hours, and that's exactly what we had here during the London session. So our cutoff for trades is 6:30 a.m. Eastern. That is this candle right here. So if we're not in the trade by this candle, we don't take trades until 8 a.m., the 8 a.m. start of New York. But what we had is we had a nice stop run, beautiful stop run, comes down, produces the break of that level here, 47.55. This candle does not confirm up, but finally we get our confirmation to the upside. So we have a beautiful confirming candle here, confirms to the upside, and then all we need right after that confirmation is we need the pullback. So I'm going to measure to the low, and basically all I want to do is I want to be taking an entry where, or entering the market within 15 pips of that low. So I'm measuring up and I'm saying, okay, well, my worst case scenario entry would be when the bid price is at 47.53. 47.53 is a worst case scenario entry. And even if you look at this at the first initial move, the first initial move here goes up and hits 40 even before New York begins. Now, if you were looking for a larger take profit, you moved your stop to break even. This got back to 47.57 roughly. And so it would have missed a stop. Even if you had a worst case scenario entry based on our criteria, you would have missed your break even stop by a few pips. And if you were looking for a bit more, you got whatever you wanted on this one. Had I been trading the London session, which I personally do not, this would have been a quick 40 pip trade in the sense that I don't look for over 40, especially on a reversal trade where we've already made the trend for the day and we're looking for the reversal. I'd rather just take the 40 and get out. Was glad to see so many members hitting on this trade. This was an absolutely textbook trade, and I thought I would just include it in this video because it was the following day and I was going to do a wrap up anyway. So, nice illustration of market manipulation. The fact is, here's the simple truth, guys. Traders, as I mentioned in the first part, retail traders constantly focus on, where should I trade from? What am I going to look at to place a trade? Smart money and the people that actually control this market look at it from a completely different perspective. That's why retail strategies, retail indicators don't work. They look at it from the perspective of where can I trade from? Banks are limited by liquidity. They have to trade and turn the market from areas of liquidity. Therefore, if you develop a criteria for identifying the searching for liquidity, which is what we do, we're identifying where smart money is searching for liquidity. If you know how to do that, well, then you're going to begin to take trades that are very likely strong identifiers for where smart money is entering the market, and that's exactly what we want to do. That's exactly what we want to do because they are the driving force behind this market. So guys, if you're not a member of Day Trading Forex Live, I would urge you to take our 30-day trial. Take our 30-day test. We have a 30-day refund policy. You don't like it, simply ask for a refund. We'll send it back. The bottom line is that it's a no-risk test. You can get access to the course, the live training room, these daily market reviews where I'm choosing these levels every night. Come test us out. Be happy to work with you, and I look forward to seeing you in the room. Until then, happy trading.